we're going to explore the difference between perpetual and periodic stock methodologies. Firstly, perpetual, as the name suggests, means it's perpetually updating. Every time you buy a piece of material or buy a piece of stock, it will increase the value of your stock. Every time you consume a piece of stock or sell that piece of stock, it will reduce the stock value by the exact same amount. Periodic means that the value on your balance sheet for your stock on hand stays exactly the same. And again, as the name suggests, it only gets updated on a periodic basis. That might be at the end of the month, end of the quarter, or worst case scenario, end of financial year, when you have a value of stock to update on your balance sheet. What this means is every time a stock item is purchased, it goes to your profit and loss, not to your balance sheet. Every time a stock item is consumed or sold, it is only updated when you have a final stock take or a stock update for your periodic stock basis. We'll go through an example of how this works now. Perpetual stock reporting. This is how it works on your financial reporting. Firstly, your balance sheet. Your stock on hand on your balance sheet will be constantly updating, as we just mentioned a moment ago. On your profit and loss, you will see your cost of goods sold, or your COGS as it's referred to, and this is the value of the goods that you have sold during that period of time. In this example for perpetual stock, we'll go through an example of 1 day of business in this hypothetical scenario. Let's assume at the start of the day you have $100,000 worth of stock on hand. You purchase during the day $12,000 worth of new stock. You have a sales value of $30,000 and the value of the goods you sold was $15,000. This would mean that the stock value at the end of the day is $97,000. How do we arrive at that value? We had an opening amount of $100,000. We purchased $12,000, but we then consumed $15,000, which gave us a value of $97,000. If you are running a finance system that is perpetual in nature, you will see each of these transactions going through your profit and loss. Every time there is a product sold, you will see the cost of goods sold hitting the general ledger for your sales, and then the same entry on the opposite side hitting your stock value. It'll reduce your stock down and increase your costs upwards by the exact same amount. What you'll see on your profit and loss is our sales of $30,000 and our cost of goods sold will be the $15,000 we just spoke about. The margin then would be $15,000, $30,000 minus $15,000 gives us a margin of $15,000 or 50% on what we have sold. You can see here that the power of perpetual stock methodology is that you constantly get accurate financial reporting and know exactly how you are performing at any point in time. Let's look at the periodic method now. On your balance sheet, for periodic stock valuations, you will see the exact same stock value on an ongoing basis until you do your next stock adjustment, which might be a stock take or a stock adjustment of some form. On your profit and loss, what you will see is the cost of the purchases for the period of time, not the cost of goods sold. So if you had a massive amount of purchases for the month or for the day or whatever period of time, you will see a very high amount of costs relative to the revenue you generate until you have a stock update completed. We'll use the exact same example that we just did with perpetual stock and how that will look with periodic stock. To begin with, we'll have $100,000 stock on hand and we'll assume that the $100,000 is an accurate value of what we have on hand at the start of the day. We purchase the $12,000 worth of new stock, we sell $30,000 again for the day, and we have a value of the goods sold at $15,000. The stock on hand at the end of the day will still show $100,000. This won't change until we have a stock adjustment. And then secondly, on our profit and loss, we would see sales for $30,000 and purchases for $12,000. Notice the difference in the language. In the perpetual version, we spoke about costs of goods sold, whereas in this case with periodic, we are looking at purchases. It is how much we have bought, not necessarily how much we have consumed relative to our sales. This means that the margin at this point in time is unknown. We have $30,000 worth of sales, $12,000 worth of purchases, and an unknown margin currently. This poses the question, what do we have to do to get accurate financial reporting? And this is where the stock take or stock adjustment comes through. What will happen at the end of the period when we have the stock take or the stock adjustment is we will now update for the correct stock on hand, which is $97,000 that we spoke about in the perpetual example. This will update the balance sheet to show the $97,000. On our profit and loss, it'll show differently to what it does on our perpetual stock methodology. With the perpetual stock methodology, you just see a single line, cost of goods sold. However, with our periodic methodology, you will see the following on your profit and loss. You will see opening stock, purchases, and closing stock. In our example, we will have $100,000 opening stock, plus our purchases of $12,000, less our closing stock of $97,000 will equal our costs of goods sold of $15,000. So that being $100,000 plus the $12,000 minus the $97,000 gets us the $15,000 cost of goods sold. From here, our profit and loss will be accurate. This is assuming that you're willing to do a stock take at the end of each day. These hypothetical examples we've just gone through is assuming one day of business. You might be asking yourself, why on earth would anyone ever use periodic when perpetual is available? It's far more accurate. I'm going to know exactly what's going on, and I don't need to do a stock take every single month. Well, in another video, which we'll have a link to, we will explore the pros and cons of periodic versus perpetual stock taking. In that video, we will explain why a lot of businesses, in spite of the shortcomings of periodic stock methodology, go to that method.